Ready? All right. Good afternoon, everybody. How are you? Go ahead and let them hear you on the live stream. Everybody say hello. If I say hello, you say hello. Hello. Great to see you all. For those of you I haven't had the pleasure of meeting, I'm Ida Rademacher. I'm a vice president here at the Aspen Institute. I co-lead the financial security program, which is one of the um, 23 policy programs here at the Aspen Institute, and I co-chair the Partnership for an Inclusive Economy, which looks across all of the different knowledge and networks at the Aspen Institute and really calls forth leaders, both from our fellowships and across our program work, to think about the ways that Aspen and its platforms can help to put a spotlight on and a platform under the leadership of others who are dealing with critical challenges that keep us from having a more deeply shared prosperity in this country. And today's particular opportunity is for me to wear both of those hats. And so I want to welcome everybody to this particular event on charting a course toward a more inclusive financial system, a collective call to action. For those of you in the room and for those of you tuning in, this is not a new thing. This calling, we've been doing it for a number of years now. We've been calling you and calling you and calling you, and really appreciate it when you've been picking up the phone. What's happened is a bit of a real momentum building, a coalition of the willing, really. A lot of people have had the opportunity during COVID, across many decades of working on issues of finance and how finance works for the good of society, the good of households, to see both where we're really excelling with that in the United States and where we're falling behind. We have the deepest capital markets anywhere in the world. We have expansive credit markets. We have huge ways that we've leveraged technology and AI and an incredible level of optimism and market innovation to really push the ways that we can make sure that finance is a force for good in the world. We've also done a lot when it comes to thinking and really creating some watermarks for other countries to look at when it comes to thinking hard and first about consumer protection and how we connect the dots between the balance of innovation and protection so that households really can benefit from the innovation that we come up with. And we still have a long way to go. When we first started the work here at Aspen a few years ago, it was in some ways picking up a baton. I was quite inspired by the 2015 and 2016 financial inclusion forums that the U.S. Department of Treasury was holding with USAID. I was looking at the level of leadership across U.S. government, across the private sector on those issues. And as we looked at the rest of the world and the way that they created financial inclusion strategies that created a whole of government approach to thinking about the ways that multiple agencies, not just regulators, not just financial institutions, but the ways that labor markets, the ways that healthcare, the ways that just wages and workers were, and the ways that we do create payments for them worked. We had a lot more coordination to do, and we didn't have, and we never have had, a financial inclusion strategy that has that quarterback approach, that whole of government approach. So we started to get excited about the idea of that, and as always with Aspen, if we get excited about it, it's only because there's other leaders who are willing to take the baton and go forward with that. And that has been happening in agencies, it's been happening in the private sector, it's been happening across consumer advocates for a number of years now. And so today is an opportunity to really put a highlight on some of the ways that leaders have been advancing this work. And because we've been in an ongoing way convening an inclusive finance working group, we've got some things to share there as well. There's a lot happening in this space right now. I'm going to get out of the way quite quickly to let us hear from some of the others in this conversation. If you're watching and tuning in from elsewhere, thank you so much for doing so. Please add questions to the chat. Send questions directly to us. While we are trying to use this as a watershed moment to both look at the progress we've made and the way that we make progress going forward, we also know that we're not done building a big tent for this work. And none of that tent would have been possible for us at Aspen without partners that not only are joining us to lead the work, but also to fund us to be able to kind of be a bit of a, a keel for how the work hangs together. So thank you very much to Wells Fargo, to the MasterCard Center for Inclusive Growth for supporting our work here at Aspen on inclusive financial systems. We're going to start. This is going to be, it truly is a mixed in-person, live, and video event. So I just look out. I've seen so many people I'm excited to see and connect with today. We're going to start off with two videos, pre-recorded remarks from some senior officials, Governor Michelle Bowman from the Federal Reserve Board of Governors, and then we will also hear from the acting director of the OCC, and Kate Griffin, who directs program here at the Financial Security Program, will come up and give a bit of remark there. So there's a little bit of video for everybody to take on first, and we're very excited to hear the work of both of those regulators in this space. Then we'll have a fireside chat here in live, and then we will really go into a great private sector conversation as well. You're going to hear more from that from everybody else, but get comfortable, get curious, and thank you so much for joining us today.
I'd like to thank the Aspen Institute for inviting me to join you at this event to discuss efforts to develop a more inclusive financial system. It really is a pleasure to join so many stakeholders that are at the forefront of this important work. As I've often said, one of our important responsibilities is to foster an economy that works for everyone. Consumers are better positioned to benefit from economic growth when they have access to financial products and services that responsibly meet their needs. My perspective on financial inclusion is informed in no small part from my own experience as a banker. Small banks, especially community banks, have a deep understanding of the local economies they serve and can quickly respond and effectively meet local needs. Indeed, financial inclusion is a core mission of community banks, but no entity or group of financial institutions alone can solve the challenge of creating a more inclusive financial system. Today, I will discuss my views on why financial inclusion is important to all of us, from community banks to central banks. I'll then highlight activities in which the Federal Reserve participates to promote financial inclusion and conclude with ideas for future work and collaboration. An inclusive financial system offers access and choices that enhance consumers' and businesses' financial well-being. From checking and savings accounts to credit and insurance, consumers benefit from having financial products and services that are affordable, safe, and responsive to their needs. Without them, consumers may turn to alternative financial services, which can often be more costly or may lead to consumer harm. An inclusive financial system recognizes that consumers come from a wide range of economic circumstances, have varied perceptions and experiences with the banking system, and most importantly, different needs for financial products and services. And despite the general availability of online financial services, geography, location, and accessibility matters. Financial inclusion may look very different, for instance, in rural communities compared to the suburbs of Washington, D.C., or the islands of Hawaii. The entire economy gains when more households achieve financial stability. That said, the benefits of financial inclusion do not necessarily result in the same outcomes for everyone. The road to fostering a more inclusive financial system is long and winding, and may, at times, seem daunting. We've been on this road for some time, and the Federal Reserve and many others have already taken many promising steps. So I'd like to share a few examples of the Fed's recent efforts to promote financial inclusion that will help to provide some context to our ongoing efforts. For many years, a variety of surveys have indicated that consumers use small dollar credit to address temporary cash flow imbalances, unexpected expenses, or income shortfalls during periods of economic stress or natural disasters. So we began to consider the ways in which the Federal Reserve and other financial regulators could be helpful. Shortly after I joined the Federal Reserve in 2019 and through 2020, we issued 2 interagency statements meant to provide clarity to banks on the use of alternative data for underwriting and on principles for offering responsible small dollar loans. Our guidance clarified that with the consumer's permission, banks can use alternative data like checking account balance activity to qualify them for credit. Our guidance also underscored that small dollar lending products that support successful repayment outcomes and that avoid continuous cycles of debt due to rollover and reborrowing can help facilitate financial inclusion. We've seen some evidence that suggests the release of these small dollar interagency lending principles correlated with a subsequent increase in bank consumer lending. Ensuring that small dollar lending is available through depository institutions rather than other non-depository lenders could increase the credit opportunities available to consumers at lower cost and with fewer fees. Banks may also pursue expanding their lending opportunities through technology innovations that provide mechanisms for more effective risk modeling or enhancing their online access to financial services for consumers. These advancements can result in faster loan decision-making, more convenient customer access, and reduced costs and risks for both banks and for borrowers. Over time, we are seeing more banks incorporating these approaches to better serve clients with credit, including the use of alternative data to support underwriting. We will continue to monitor these promising developments to better understand the impact on consumers. So I'll turn now to the Fed's efforts to build the institutional capacity of a set of key stakeholders: minority depository institutions, women-owned depository institutions, and community development financial institutions, whose missions are to reach historically underserved populations. Providing support for these institutions is an important part of the Federal Reserve's mission to provide a safe, sound, and accessible banking system that protects consumers. Through the Fed's Partnership for Progress program, we provide technical assistance on regulatory matters. We conduct research, we host convenings, and provide examiner training to support and promote the stability of MDIs and WDIs. Research suggests that MDIs are more likely to focus their products and services to benefit diverse communities and to work with more consumers who experience credit constraints in comparison with non-MDIs. The extent of their reach was evident during the 2008 financial crisis and the COVID-19 pandemic, when they demonstrated effective contributions to the economic resiliency of their communities. During the pandemic, MDIs and CDFIs provided Paycheck Protection Program loans to small businesses and financially underserved firms. The Fed supported these important financial service providers by providing liquidity through its emergency lending program, the Paycheck Protection Program liquidity facility. The Emergency Capital Investment Program provided additional support to MDIs and CDFIs. Through ESIP, MDIs and CDFIs received over $8.5 billion in low-cost capital to support the provision of loans and grants to small businesses and consumers in their communities. The Federal Reserve conducted collective webinars and individualized outreach to MDIs to encourage enrollment in that program. Our early internal analysis shows that on average, eligible banks are using ESIP to strengthen balance sheets, build internal capacity, and enhance product offerings. As a result, we've seen ESIP recipients increase their lending about a year after receiving funds, relative to MDIs and CDFIs that did not receive ESIP funding. This brings me to another aspect of the Federal Reserve's efforts to support financial inclusion. The Fed recently became a member of the Central Bank Network for Indigenous Inclusion. This group brings together the central banks of the United States, Canada, New Zealand, and Australia with the purpose of understanding and researching related economic and financial issues, knowledge sharing, and financial education targeted to these communities. As the Federal Reserve's network representative, I recently participated in the CBNII's biennial symposium focused on the importance of Indigenous financial inclusion. My remarks there reiterated the view that a financial system must be inclusive for the economy to work for everyone and must include access for Indigenous communities. Our work with Indigenous groups includes all U.S. Native populations, Native Hawaiian, Native Alaskan, and Native American Indians. The Fed's CBNII work is supported by many of our Reserve Bank teams, including the San Francisco Reserve Bank, the Minneapolis Center for Indian Country Development, and the St. Louis Native Economic and Financial Education Empowerment Program. Together, these teams and programs work with Indigenous organizations and tribal nations to provide access to economic and personal finance education, incorporating Indigenous language and culture. As a final example, I'll highlight some of the Fed's financial inclusion data and research. Two of our most important contributions to the study of financial well-being and consumer wealth are the Annual Survey of Household Economics and Decision-Making, or SHED, and the Triennial Survey of Consumer Finances. Responses to these surveys are publicly available and are extensively cited by other practitioners and researchers. Researchers and practitioners also rely upon the St. Louis Reserve Bank's Bank On National Data Hub, which was created in partnership with cities for Financial Empowerment's Bank On program. Through voluntary and aggregated data reporting, this resource enables the public to track the growth and usage of Bank On accounts in communities across the country. We encourage the public's continued engagement with and analysis of these important data. So today, I've spoken about the Fed's work in the areas of small dollar credit, mission-driven organizations and networks, and data. So before I close, I'd like to raise several issues on my mind that might prompt discussion in your event today. First, building on some progress in small dollar credit, how can we encourage the development of lower-cost products and refine our understanding of the degree to which these products may foster consumers' financial well-being? Second, given the value of mission-driven organizations and expanding access to financial products and services in underserved communities, how can we best provide support to the activities of MDIs, WDIs, and CDFIs? Third, the CBNII relies on the participation and wisdom of Indigenous leaders and community members to advance financial inclusion. How can we leverage this model of engagement and shared learning? Financial inclusion is not a one-size-fits-all issue. Involving consumers and communities in identifying issues and crafting approaches for solutions is critical to success. Advancing financial inclusion will clearly take many hands and a diverse set of stakeholders, including everyone participating here today. So in closing, Greater inclusiveness in the financial system is an ongoing priority for the Federal Reserve, and we will continue to engage on these important issues in the years to come. Progress requires collaboration, and I look forward to engaging with all of you as we continue on the journey to make our financial system more inclusive.
Good afternoon, everybody. I'm Kate Griffin, and I serve as the Director of Programs here at the Aspen Institute's Financial Security Program. It's so delightful to see so many of you here in person and to know how many of you are following along online. And we are grateful to Governor Bowman for her time and her staff's time in working with us, not just to hear her thoughts today, but also in our work towards a more inclusive financial system. As I reflect on what she just offered, I think it's a very interesting example of the interrelated issues at play when we start to think quite critically about how all aspects of our financial system can be oriented towards improving outcomes for people, which is really, I think, the crux of what we're here to do. She spoke about the tools that they have at their disposal, whether it is regulatory clarity, research, capacity building. And I think it is a really important inspiration for us to think about all the different aspects or spheres of our influence that we might have at play to be oriented towards this. So as we gather today in this conversation, I think there are two themes that I hope you continue to hear over and over again. One, about collaboration. And that in this exciting moment that we have together, all the work that's happening, the exponential impact that we can have when we start to work together or keep working together. And second is this focus on really delivering for everyone in this country a better set of financial outcomes. To that end, if you're curious about what that could look like or how we could even begin to track progress toward that, we had the Financial Security Program published a report just a couple of weeks ago with a recommended framework for metrics for how we could look at tracking household financial stability, wealth, resilience, and ultimately household financial health and well-being as a North Star for this work, and to keep us grounded in what matters. As we continue our journey to kind of learn a little bit more about how our federal government is leaning into and working towards a more inclusive financial system, it's also our pleasure to welcome the Acting Comptroller of the Currency, Michael Hsu. He and his team have, similar to Governor Bowman, been really thinking deeply about this question and about their role as a regulator, as a banking regulator in this country. So we'll hear here on the video from Acting Comptroller Hsu.
Good afternoon. Thank you for inviting me to join you today. I'm pleased to be amongst this diverse group of leaders working to build a more inclusive financial system that provides opportunities for everyone. I applaud the Aspen Institute's leadership in this important work. And I'm pleased to share with you some thoughts about how our work at the Office of the Comptroller of the Currency is aligned with the goals of this gathering. The OCC is committed to its mission to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. All of these elements converge to support a financial system that is anchored in trust, so that banks can meet the financial needs and aspirations of their consumers. Since becoming Acting Comptroller, one of my priorities has been to reduce inequality and support a more inclusive financial system. The Community Reinvestment Act is a key tool for expanding financial access for low and moderate income people and communities. The CRA encourages banks to be inclusive in their lending and investments, and thus supports a key component of the social contract between communities, banks, and the federal government. In October, the OCC and other federal banking agencies issued an interagency final rule to modernize and strengthen the CRA. The new rule is focused on expanding access to credit, investments, and basic banking services, adapting to changes in the banking industry, and providing greater clarity, consistency, and transparency in qualifying activities. The new CRA rule will support financial inclusion, For example, it encourages large banks to provide credit and services that are responsive to low and moderate income consumers through both branches and remote delivery. The CRA also encourages banks to support and partner with community-based entities such as community development financial institutions and minority and women-owned depositories, which serve diverse populations. The new rule incentivizes bank activity in places such as native lands, in areas of persistent poverty that have often been overlooked. Additionally, it recognizes the potential adverse impact of natural disasters and weather events on community and household financial stability, and enables disaster recovery, preparedness, and resiliency to help families and communities prepare for, adapt to, and withstand such risks. In addition to the CRA, the OCC is engaged in several initiatives to encourage banks to serve the needs of their consumers and communities. Last April, the OCC issued guidance to banks to address the risks associated with bank overdraft protection programs. The guidance also served to encourage banks to consider ways overdraft protection programs may assist some consumers in meeting short-term liquidity and cash flow needs, and to explore offering low-cost accounts, as well as other lower-cost alternatives for covering overdrafts, such as overdraft lines of credit and linked accounts. Through Project REACH, the Roundtable for Economic Access and Change, the OCC convenes representatives of banks, community groups, civil rights organizations, and tech firms to work to remove barriers to financial inclusion. To date, participating banks have launched new loan products to provide credit to consumers without credit histories and committed more than $500 million to strengthen MDIs. Additionally, Project REACH workstreams focus on expanding opportunities for minority-owned small businesses and addressing affordable homeownership. To expand access to credit and to help address the racial wealth gap, the OCC has encouraged the use of special purpose credit programs, authorized under the Equal Credit Opportunity Act. These programs allow lenders to extend credit to groups of economically disadvantaged people who might otherwise be denied credit or would receive it on less favorable terms. Earlier this year, along with my colleagues at HUD, FHFA, and the CFPB, I highlighted to lenders the availability of special purpose credit programs as a resource to reduce the racial wealth gap by helping consumers buy homes and grow businesses, which are both important to an inclusive economy. To complement such events, the OCC Community Affairs team issues publications, hosts convenings, and facilitates relationships between banks and community stakeholders to promote financial inclusion. As part of this work, we've begun exploring the development of real-time measurements of individuals' financial well-being, which we refer to as financial health vital signs. The idea is inspired by the medical field and its use of vital signs like heart rate, temperature, and blood pressure to quickly assess patients' health. What if we could do the same for individuals' financial health? What if individuals' financial data could be used to quickly identify and track their financial stability, resilience, and security, the outcomes that financial inclusion is seeking to achieve? Notably, this work is highly complementary to the Aspen Institute's North Star framework, which measures 3 aspects of financial inclusion across 5 types of financial services. The underlying idea is the same. Focus on a set of measurable component outcomes to inform and guide efforts to expand financial inclusion. I appreciate the insights that the Aspen Institute and others have shared and the work that continues to be advanced in this area. I particularly applaud the Aspen Institute for emphasizing outcome measurement in its vision for financial inclusion. I'm proud of the OCC's achievements so far in working towards an inclusive financial system. I look forward to working with the Aspen Institute and other interested stakeholders towards a financial system that allows everyone to have the opportunities for a secure present and a brighter future. Thank you.
Did you hear that? Collaboration, outcomes, focus. No, we are grateful to Acting Comptroller Sue and to his team. We really appreciate the opportunity to engage in this conversation with you all, and are excited to hear more about financial health vital signs. As we continue our journey through the federal government, and really exploring the ways that so many leaders are thinking very deeply and critically about the role that they can have, I am very excited today to welcome to our stage 2 people who have been thinking very deeply about the role of the Treasury Department. and their leadership in this work. Can I invite you two gentlemen to join us on stage, please? We're going to welcome today David Clooney, who is the head of community relations at Edward Jones, the former CEO of the Black Economic Alliance and the executive secretary of the Treasury Department during the Obama administration. He'll be in conversation today with Assistant Secretary of the Treasury for Financial Institutions, Graham Steele. Gentlemen, the stage is yours.
All right, I'll keep talking. And there it is. Wow. Good afternoon, everyone. Great to be with you in person. And Graham, great to be with you, Assistant Secretary Steele.
Nice to see you.
So I thought we'd start with a question, and I'll participate, but I'll ask you to go first, and I'll follow you. Just about how you came to this work, a little bit about your background, and how you came to get engaged in financial inclusion work.
Sure, great. David, nice to see you. Glad we get to have this conversation. Thanks to the Aspen Institute for having us and for hosting this really important conversation. So maybe if it's helpful, I can start with what the Assistant Secretary for Financial Institution is and does. Usually when I introduce myself to people, they kind of like nod along, like their eyes glaze over and they're like, they have no idea what that means. So what is the Office of Financial Institutions at Treasury? Obviously, you know what it is, but maybe for the folks that don't. We are within the Office of Domestic Finance, and we are responsible for the department's policy views related to financial institutions such as banks and credit unions, but also non-banks, fintech companies as well. We do insurance policy. We have an Office of Consumer Policy, the staff of whom is here. I think put your hands up, everybody. So we are responsible for Treasury's views around consumer protection, consumer policy, and financial inclusion issues. We have an Office of Community and Economic Development, including the Community Depository Financial Institutions Fund. And then my fourth office is the Office of Cybersecurity and Critical Infrastructure Protection, which is the sector risk management agency for the financial sector dealing with cybersecurity and operational risk. The theme across all those offices is fundamentally a financial stability one: safety, soundness, and enduring and inclusive products and services for consumers. So how did I get into this space? How did I end up with this job? I've wanted to be in public service since I was 8 years old. I am from a town in Massachusetts where my neighbor, when I was that age, was the governor of Massachusetts, a guy named Mike Dukakis, who was running for, yeah. All right, you heard of him. You heard of the Duke. I think he just turned like 92 or something like that, which makes me feel very old. But he was running for president at the time, and I didn't know what that was or did. I found out what DC was, and I said I want to be there someday. And so I came down here for law school, started working at a consumer protection-oriented nonprofit. That was my first job out of law school. And then the financial crisis happened, and that was a very formative experience for me in a number of ways. I saw a lot of folks in my family and my community impacted by that: foreclosures, lost jobs, and the toll that took in my community around me that I had come from. But it also, I got a job working on Capitol Hill, working for a great member of the Senate Banking Committee, a guy named Sherrod Brown, and we were working on the reforms to address those issues. And so my job at that time was both working on the overhaul of the financial sector to try to address the problems that had led to that crisis, creation of the CFPB and other things like that. But one of the great things about Hill jobs is also you do a lot of constituent work, and Ohio was experiencing a high number of foreclosures. And so half my day job was doing the policy work, and half of that job was helping people stay in their homes and fundamentally seeing the human toll that took. And I think that's why I found this job at Treasury to be so rewarding, and why I care deeply about these issues is the human side of this. The secretary, when she was at the Fed, said that the unemployment rate, the people behind those numbers were more than just statistics. It is about the human side of these products and services and these issues. I think it's been really great to work for a secretary, a deputy secretary, and an undersecretary who really understand that and really care deeply about financial inclusion and wealth building.
I appreciate that perspective. I also appreciate you leading with manners. I may not be asked back because I did not say thank you to our hosts here at the Aspen Institute, particularly Ida, Kate, and the folks at the Financial Security Program, the great work and important work you're doing. Thank you for having us. Thank you for organizing this conversation. I'll give a little bit of perspective of my own journey to this work. I'll start with, my kind of personal lived experience and then my professional experience, just the experience of growing up Black in America and, watching my family and those around me really struggle with access to capital. And my father was a loan officer for, at the time, Chase Manhattan Bank, making loans to small businesses in the Bronx and Westchester. And, just hearing his stories about how folks were struggling to get the access they needed. And in some cases, even when they did, it wasn't quite enough to keep them afloat. But, professionally, I was both going to the Howard University School of Law here in DC, learning about kind of having obligation to social justice and just the role that economic empowerment plays in that, and then really going to the Treasury Department during the Obama administration, and then to the largest bank in America, working in government relations and corporate responsibility, really seeing firsthand the struggles at an organization that, even when it would apply itself to try to improve financial inclusion, some of the roadblocks it hit internally, externally, and then really going to the Black Economic Alliance after that, and working with folks who had themselves been successful getting access to capital markets and opportunities, professional opportunities that were so far the exception, not the rule, for most communities of color, low and moderate income communities, particularly the Black community. So that's really driven me throughout my career, and now has landed me at Edward Jones, and standing up a new body of work there. And I think it's really important that this be a priority in the public, private, and nonprofit sector. So I've been really fortunate to be able to work in all three spaces. So great to be with you here today. You talked a little bit about your office and the current scope of the role of the Assistant Secretary for Financial Institutions, but you and I are both old enough to remember. We don't need to go into the specifics of that, but I think the changes we've seen to financial institutions in just the last 20 years, is a greater pace of change than we've seen in a generation. And I think the term, what a financial institution is a different concept now than it's been in the last, even when I was at Treasury 10 years ago. But also the role of your office and really the role of financial institutions in driving financial inclusion continues to change. So I want you to talk a little bit about how you think about the role of financial institutions in driving financial inclusion and really the kind of current role of your office.
Yeah, I'll try to do that without totally giving away my age, although I kind of did it a little bit when I talked about the '88 campaign. But I think when people think about financial institutions, at least when they used to think about it, they would think about the kind of what the governor talked about, with the bank down the street that's making the mortgage loan for a family that wants an appreciating asset but also wants a place for their family to live, or that makes the loan for someone to buy a car to be able to get to where they want to go to work, or that has that savings account for them to put their money in a safe place to earn a little bit of interest, and just make sure that they're able to build a little bit of wealth. And banks are vital providers of those kinds of bundles of products and services for sure, but there are more products and services coming online now. It does feel like both the change in the offerings and the technology and who is in these spaces has changed a lot in just the time that I've been doing work on these issues. And so that's one of the things we had to think about at the department is, what are the role for those incumbent institutions? What are the role for these upstarts that want to come in and challenge them? How do we think first about competition and innovation? So how to make sure it is responsible, that we're getting the best out of the benefits of competition, so lower prices, better products, and trying to meet a wider range of customers to actually push that so it's healthy and one kind of institution is pushing the other. At the same time, the thing that's top of mind for us is to make sure that that's done responsibly and really put the emphasis on responsibility. And sometimes that's got to come through things like consumer protections and regulations to make sure that populations aren't being discriminated against, that certain underserved communities actually get their needs met, and then fundamentally that certain communities and populations aren't being preyed upon by predatory products and services. And so striking that balance between the competition and the regulation, we really see as a key role for the administration, for the independent regulators that talked already, but also for the Treasury Department. The last piece that I would say is that we at Treasury have our own role to play in providing some products and services. The Bureau of Fiscal Service processes most of the payments for the federal government. When COVID hit and the IRS had economic impact payments to make, the Bureau and Fiscal Service played a role in that. The IRS played a role in that. And so I don't think the governor talked about it, but FedNow obviously is another innovation where the public sector is now providing a real-time payment system that will hopefully bring down prices as well. And so that's a thing that we are thinking about all the time, is how to get the benefits of the private sector innovation, try to prevent the predatory practices from happening through regulation. And then the third piece is what's the public role here in doing some of that direct provision to make sure that people are getting the kind of products and services that they need.
That's great. So you have recently announced your intention to depart from the Treasury Department, and let us first say thank you for your service. This is really important work, and I can say, from my perspective, we've never seen this level of commitment to racial equity, financial inclusion, battling and counteracting income inequality that we've seen from this administration and this Treasury Department. So we appreciate the work that you've done, and we're all working toward making sure that this is building a foundation for a body of work that will continue beyond this administration and beyond your tenure. So thank you for your service. Reflecting on your time at Treasury, interested in what you're proudest of. What is maybe an accomplishment you're most proud of, and thinking about what you've accomplished, what does the road ahead look like for this work of financial inclusion?
Sure. And I appreciate the kind words about the work the department has done. That has really been a point of emphasis. And I think that just goes to the importance of having a secretary that cares deeply about these issues, having a deputy secretary who cares really, really deeply about these issues, and having a dedicated counselor for racial equity, Janice Bowdler, who I'm sure a lot of folks in this room know, who really keeps us all, keeps our eye on the ball. But I think one of the ways in which that role has been really useful is that it is a place to lift up those issues, but also we have gotten a message from the top down that it is all of our jobs. It is not just Janice's job. It is incumbent upon all of us that run the day-to-day programmatic offices to think about how equity feeds into the work that we do. And so that has really been a nice thing to watch from the leadership in the department. It was the thing I was hoping coming in would be emphasized, and it has been. So that's been really great and reinforcing. Think about the things that have that I'm the proudest of. It's like trying to pick amongst your children, I guess. I mean, I don't have kids, but that's what I hear. I think there've been a couple different aspects of the work in the 2 years that I've been there, which feels like 2 years, it feels like 2 decades, and also feels like it's been 2 weeks at the same time, just in the way that some of the events have come to pass. I think one of the themes has been stability in trying to stabilize the economy coming out of the pandemic in 2021. It feels like eons ago, but we were really in a precarious position there, and Treasury was at the center of a lot of the work of trying to actually put the economy on a more stable footing. I mentioned the economic impact payments. That was an opportunity for us to try to work with the FDIC. I see Jonathan Miller in the crowd, to think about those kind of bankable moments, how we can use some of these payment functions, then try to get folks into the banking system a little bit better. I mentioned the cybersecurity portfolio. There's been an uptick in those kinds of attacks, particularly with the Russian invasion of Ukraine, just trying to make sure that payment operations and the functions of financial institutions continue even throughout those geopolitical threats. There's been another area of stability we've really tried to focus on. And then one that became very painfully salient for us was some of the stuff that happened in the banking sector in March, April, and May of this year, of a fundamental lack of trust in the soundness of certain financial institutions, and thinking about how to restore stability there and restore confidence amongst certain customers in their banking institutions. And so that's one piece, is I think the work we've done to try to really stabilize both the economy and the financial system hasn't been fun, I would say, but it's been really rewarding and really getting to be on the front lines of some of that work. I think a second theme has been investment. So some of that is some of the historic investments at the end of 2020 into 2021, coming out of the pandemic. We've invested about $8 billion in broadband to try to invest in communities that are underserved by those kinds of services. My Office of Community and Economic Development, I think Governor Bowman mentioned the ESIP program, but we've gotten historic appropriations in just the last 2 years. The fund has gotten more money than it had in the prior 30 years of its existence from Congress. It's not enough. There's much more that has to be invested in underserved communities, but that money's gone out the door into CDFIs and MDIs to turn around and invest it in low-income communities as well. So I would be remiss if I did not also mention the great work done by the Financial Literacy and Education Commission in lifting up some of the issues that we've seen in Native communities as a result of the risks of climate change, and the challenges faced by justice-impacted individuals. And so I think it's the combination of that work we've done to try to both stabilize the economy and the financial system, but also make sure the investments are getting out there and getting into the communities that really need them, that have felt like some of the most consequential and rewarding work so far.
So luckily, your accomplishments won't get jealous if you choose one over the other. Children will. I've seen people crash and burn on that before. So, and you mentioned some of the professionals at the helm of the department right now, and you're absolutely right. Some of the best minds in America working on this, and former colleagues of mine, Deputy Secretary Adeyemo from the public sector, Janice from the private sector, and great friends and current colleagues as well. I have the pleasure of sitting currently on the Treasury Advisory Committee on Racial Equity, the first ever formed by this administration, by this Treasury Department. In fact, we're meeting later at Treasury this week, so I'll see you again. I think we've, and this is the last question I'll ask, it's around, I think in recent years, and keep me honest on this if you disagree, there's been a bit of an awakening of how much of an impact our action and indeed inaction on financial inclusion will have on the entire economy. That's local economies, the national economy, and even the global economy. We've seen great research about how much opportunity we've lost in the way of potential output and what the opportunity is if we are to close certain gaps, particularly the racial wealth gap. So with that backdrop, I think about, and again, I've had the benefit to work in different spaces, the need, and Governor Bowman talked to this, and I think everybody has spoken to this. Kate and the Financial Security Program speak to this directly. The need for an all-hands-on-deck approach across sectors, public, private, nonprofit, and that's certainly the work that I've done in all spaces. We try to bring folks together, play convener, and do that. But interested with that backdrop on the work you all are doing currently in financial inclusion, and get a sense of the landscape right now of what's happening there.
Absolutely. As I think folks in this room are well aware, and Aspen was instrumental in doing some of the work and laying the groundwork for us to start working on the first ever comprehensive strategy for financial inclusion for the federal government in last year's appropriations law. So that's what we're doing. We've been doing it for, God, it's been 11 months now, hasn't it? Okay. Again, feels like 11 months and 11 minutes at the same time. So those issues are really top of mind for us. That kind of charge from Congress is really helpful to really focus our attention on the issues that matter and to get us to really put our full weight behind that kind of effort. We've had some great, it's very helpful to have willing partners in both the nonprofit, the private sector who want to do this work with us and have done it with us over the last 11 months. Maybe I can talk a little bit about some of the ways that we're thinking about that strategy and then a little bit about some of the next steps there. The first thing that we've heard in a lot of the conversations we've had so far is there are certain areas that we need to focus this work on. It's financial inclusion. So the first area was access, thinking about closing that gap. The fact that I'm going to kind of mangle the way that I say this, but the percentage of people in communities of color that are unbanked is 5 times that of white communities. So how do we actually close that gap in access to these kinds of responsible products and services? That's step one for us, is thinking about really getting those products and services out to the folks who really need them and want them on the ground. And so that's sort of phase one to us. But as Kate mentioned earlier, we've also got to be thinking about those outcomes as well. So how do we think about that racial wealth gap where the average white household has 6 times the wealth of the average black household? So it's the access, it's are those products and services really meeting the needs that people have in order to build that wealth and make it intergenerational and really solve some of the broader structural issues. And then the third piece of it, which has been really helpful to get feedback, particularly at one of the recent listening sessions that we had, and Tim from Aspen was really great in lifting up this issue for us as part of the conversation, is we also want to think about how to meet people where they are in terms of how they want to use these products and services. The governor talked about the issues in rural communities, but it's true across all different kinds of populations, urban, rural, white, black, Latino. Different people have a different need for different products and services to serve different ends for them. We've really got to understand that day-to-day lived experience of people and think about how to make these recommendations so that we're setting some clear guardrails, but also understanding that more granular texture day-to-day experience, and having some of that flexibility so that folks are really interacting with the system, with institutions, with the government, and with each other in the way that they are the most comfortable, that really get them in there and really sustain it. And I'm using kind of abstract language. I have examples that I can think of a vision impaired neighbor that I have who will only do any kind of he does not own a smartphone, who will only do transactions in person because he knows the teller in his local credit union, he trusts that person, and that's that. We've got to really understand that day-to-day lived experience, I think, in addition to the access and the outcomes, to then think about what's best for people. And so I think that's kind of where the next phase of this goes to me, is understanding the broad principles and how we balance some of those things to really, get some broader structural outcomes out of this strategy. So, as I mentioned, we did one roundtable relatively recently that I had the pleasure of participating in, that Aspen was a part of, along with a number of other private sector stakeholders. We'll be doing later this month a request for information to get written comments from folks to then think about that next round of engagement. There's more to be done, more conversations to be had to think about how we unpack some of these issues, I think.
Well, that's a great place to end. So let me do two things in closing. First, thank you, and I will use your full title while we still can. Treasury Assistant Secretary for Financial Institutions, Graham Steele, not only for your time today and your contribution to this conversation, but for your service to our country and to a more inclusive, resilient economy. So thank you for your work there. Second and last, we are good at convening these conversations, and we could leave the room and come back next year and simply update the numbers of where we are. Instead, I know our colleagues and friends at the Aspen Institute and all of us in the room would love to be action-oriented. So I will just leave folks with, the title of this is a call to action, and for all of us in the room to think about what role we can play. I know a lot of folks are doing great work in this space already, but I would love to come back a year from now and be able to do the before and after of what we've done in the last year, and continue to do that year over year as we make progress on this significant task in front of us. So thank you to the Aspen Institute.
My pleasure.
I'll let you-
I'll just be some guy in California at that point, but I hope my successor comes here and has a really good story to tell for you all. But thanks, David, for your great questions and the conversation today, and thanks again to Aspen.
Thanks.
Thank you both so much. We really appreciate you spending some time with us today. And I think it is really and truly a call to leadership that we are hearing about from many of these public sector leaders who have taken some time to share with us how they're thinking about these items. And I want to say, those of us in the room, we're going to have a chance here in a little bit to talk about our own calls to leadership over some drinks. For those of you online, there's also an opportunity to engage, and we'd love to hear your questions and thoughts as we are having this dialogue on stage here. So just encourage you all to be taking part in that. We want to pivot our conversations now. And along the theme of collaboration, it is exciting to see the work that Treasury is doing to work on crafting this national strategy. But it will require, in fact, action on all of our parts. It is not just a strategy for what will the Treasury Department do or what will the federal government do, but what is important for all of us to be doing collectively together to advance outcomes for people. And in that vein, I'm really excited, actually, for our next speaker. We've worked over the last several years with Salah Goss, who is a senior vice president at the MasterCard Center for Inclusive Growth, who in her own work has had the opportunity to be present at the writing of several national strategies for financial inclusion and see up close and personal both what it takes and the value and the impact of having those items. And so, Salah, I'd love to hear your thoughts on where we are and where we're going.
Hi, everyone. Let's try that again. Hi, everyone. I say that twice to convey my excitement, and I'm really excited to be here because it has been a journey, but one that we were so happy to take. And this is just really a good moment and milestone. So I want to take that in as I start to just hopefully run through quickly a couple of the things that I wanted to leave you with. Part of the reason we went on this journey is because we know the power and we know what happens when public and private sector work together. We know the ability to just that power to bend the trajectory of households and household welfare when that happens. And we're not alone. So Kate said I'm at the MasterCard Center for Inclusive Growth, but there are companies that and institutions that are with us in this work and have been for a while. There's Citi, there's Cap One, there's the Urban League, Wells Fargo, PayPal, PolicyLink. There's over 101 companies, nonprofit organizations, and institutions that have signed this letter to Treasury that kind of kicked us all off to really underscore the importance of this work. And also, we're not alone globally. Kate mentioned some work that's been done around the globe, but we know that as of 2021, 73 countries have signed the Maya Declaration. And the Maya Declaration was put out about a decade ago for the Alliance for Financial Inclusion. It was the first time that there was a global standard measurable for financial inclusion. 73 countries have signed, and 60 countries already have national financial inclusion strategies. So we hope to join those countries very soon. We've seen the power kind of what that means. And in the US, staying there for a while, we're seeing, it's a study, I think somebody quoted, we cannot go through convening without someone quoting a McKinsey study or a Fed study. But if we think about the US, we think about more inclusive systems. There was a 2019 study that showed from McKinsey that US real GDP would increase 4 to 6%, which is not small, if we had a financial system that was more inclusive and got rid of some of the racial and other kind of systemic barriers that leave people out. We've learned comparatively from other countries where we've seen the success of national financial strategies and how they galvanize cross-sector collaboration. So I had the pleasure personally of seeing this in both Tanzania and Nigeria, and really could see how the economics of serving financial excluded populations, which we can't ignore, and just the aperture of access, how digital transformation was actually sped up by a consistent policies that help the private sector innovate. And even in the UK, as we're learning from Europe, we know that there's a private financial inclusion commission that helps set measurement standards, and actually is helping to push their financial regulator for mandates along financial inclusion. And so we know comparatively in terms of even between countries what this means, but somebody mentioned real people, and right, like that's why we're here. So also, what does it mean for households when we think about the fact that that Fed study that I can't get up here without quoting, that a majority of households can't put their hands on $400 in an emergency. And think about that, like the stress of an emergency, where do you look to help mitigate this stress and not being able to get that money together? But we also know if you even look at the CARES Act, I think it's 63 million recipients had to get a paper check, right? And that might seem like just inconvenience, but I think the number is somewhere around 66 billion, 3 million paper checks were issued. That was 66 million in check cashing fees. Now that's coming from 63 million Americans who are banked or underbanked, who spend $125 million overall in check cashing fees and 46 billion in non-bank money transfers. That is real money that could be going to households for all of their aspirations, the visions they have for themselves, and prosperity. That's real money and real pain for the households that are just going to things that are there because of not being included in the financial system. But the thing is that we know that there is an approach that could be taken nationally that could mitigate some of the burden that these families face around the country. We know that there's an approach that will help reap the benefits and get more value out of the both public and private sector initiatives to make these financial emergencies less frequent when they happen, and make the immediate solutions that households pull on less painful. And we've been doggedly focused on this work because we know what it means to develop a coordinated, comprehensive approach to building a more inclusive financial system, but with an overarching strategy. And the strategy that defines national financial inclusion objectives and set forth a list of priority actions. We know that it'll help accelerate progress toward a financial system that more people can benefit from. simple but complex statement. And that the ultimate goal is an inclusive financial system that enables all people to have access, use, and reap the benefits of quality products, ultimately for a stable, resilient, and long-term financial health. That's really what we're talking about. And we've seen some important milestones I want to just mention quickly. You've heard some of them. So we have over 110 companies and institutions that have signed up. We've been able to meet as a group in the working group to understand more deeply what inclusive system looks like. Treasury, who you just heard from, has made public statements in terms of having a national financial inclusion strategy. FSGG report language in 2022 asked Treasury to report on that, and we are very much looking forward to that RFI that was mentioned. Let me just close by just mentioning a couple principles. So in 2021, I was fortunate enough to contribute to the book Future of Wealth that Aspen and St. Louis Fed put out. And I wrote a chapter with Jennifer Tresher called Toward a More Inclusive, Equitable System. And we laid out principles for what that looks like. And I think they're very much applicable to here when we think about what does a strategy have to look like and what can a commission focus on. So there's three I'll mention quickly. One might sound simple, but has to be an intentional designing for financial health outcomes. That ensures that financial health and well-being are really the stated end goal. So then you have an imperative of working backwards to make sure policy and practices make that true. The second one is designing for digital first and integrated systems. We've seen in different countries and even here how you can use technology and leverage technology to not only include more households, but have an easier, more cost-effective way to have better quality servicing, onboarding, and access for left-out populations. And lastly, and you've heard it a couple times, and it's part of your theme, Kate, but really putting a finer point on designing to uproot bias in communities that have been historically left out, because it doesn't happen automatically to include those groups. So I'll end where I started, just marking what an incredible milestone this is, and in David's vein, a call to action. And what I'll say is, if you're not involved in this work, a lot of people are, but I know there's people out there in internet land also listening to us. If you're not involved, take a minute to learn more, get involved, and I would encourage everyone in this room to keep singing, and those on the phone to add their voice to the chorus of nonprofits, our government partners, and private sector, because we believe in and have seen the power of a National Financial Inclusion Commission, and we want to invite others to come along with this journey with us. We're making great progress, and just think about the impact we can have. Like someone said, these aren't figures that we're talking about. These are households striving for a better future, and I think we owe it to them for collective action. Thank you.
If I just talk, does it work? Okay, great, good. We have come to a pretty exciting moment in this conversation, and we are going to have a little bit of a look behind the scenes at what our working group on inclusive finance has been working on. So as they join me up here on the stage, I would like to invite my panelists. We have Joanne Barefoot, who is the CEO of the Alliance for Innovative Regulation, Jesse Van Tol, the CEO of the National Community Reinvestment Coalition, Dawson Hermany Horses, Managing Director at Wells Fargo and Head of Native American Banking, and Hillary Cheedy, the Chief Sustainability Officer at TransUnion. Now, these are just four of the leaders who joined us in this working group on inclusive finance, which really from about maybe around June is when I started making phone calls to all of you. To today has really worked at a breakneck speed to have some really important discussions and prioritizing of how we could move forward on making our system more inclusive. First, I want to say, for those of you that have been involved in the working group or joined some of our subcommittee conversations, can you raise your hands? I want to recognize your leadership. And online, if you were a part of it, write in the chat, tell us about the role that you played. I am grateful I am humbled. It has been really the honor of a lifetime to work with all of you, and I have learned so much. And one of the beauties of this conversation has been that it has really been all parts of our sector that have contributed to this dialogue. Even here on the stage, you see two very important but distinct nonprofit leaders working on different aspects of our financial system. You have two incredibly important parts of our system, one of the largest banks in America, a credit reporting agency, but fintechs and technology companies, credit unions and community banks, all kinds of nonprofits and civil rights organizations. Everybody has a really important view and stake on what's happening inside of our system and what's working and what's not. And I've been so impressed at the dialogue that's resulted. So what did we do? And what did we come up with? First of all, before I get there and explain a little bit about more of what we do, I'd love to really just invite each of you to share a minute or two. And they've been told that we've got a lot to get through, so we'll be brief. Crisp. I like that.
Have you met us before?
I have, yeah, and I believe in you, Joanne. What made you say yes when you heard about this work that we were doing, and why did you decide to commit some time and some of your staff time to this working group on inclusive finance? I'm gonna, just because you're right next to me, Joanne, I'm gonna go for you first.
Wonderful, thank you. And I know you asked us to self-introduce again. So I'm Joanne Barefoot. I am co-founder and CEO of AIR, the Alliance for Innovative Regulation, which is a nonprofit working in this space. And I said yes, partly because it was you. And the Aspen Institute is such a leader, always has been, but in the last few years, you've been doing so much fresh thinking in this space. I wouldn't have dreamed of not saying yes. But the other thing is just the moment that we're in, and especially the transformational power of technology. I'm not someone who thinks technology is a panacea that's just going to automatically solve all our problems. Quite the contrary, it's going to cause a lot of problems. It does cause a lot. But still, the revolution underway in technology, specifically in finance, makes it possible to do things we could never have dreamed of before.
Yeah, it is quite the moment, isn't it? And to do this and say, let's harness that power for good. We have a call to action there.
Jesse Van Tel, President and CEO of the National Community Reinvestment Coalition. I was born in Memphis, Tennessee, and until I was about 12 years old, my family, 7 of us, lived in a 2-bedroom rental house. And around that time, my mother went back to school. She was a college dropout because she couldn't afford to go to college. Her parents didn't believe that women should go to college. And she became a doctor. And as she became a doctor, my family was able to buy a house, and that transformed the stability of my life, having moved around every couple of years. I grew up on the south side of Memphis. Really significant. But when they went to get that loan, they didn't have a credit score to establish credit. We were poor, but they had never taken on any debt. They had to get a Sears credit card. They bought a rototiller with it because they liked to garden in the backyard, and that transformed our life. I think often about that experience, both what it tells you and what it doesn't. That a bank was willing to make that loan. It was an FHA loan. It was a CRA loan. But to a white family where the mother was becoming a doctor, so that was inclusion of a sort, but not that deep. And we need to go much deeper, and there are a lot of people left out of that. So, I just remember hearing, I think, Ida speak about the need for a national inclusion strategy, and part of that really thinking about other movements, the climate change movement, where you have this real clear articulated goal, net zero. Everybody knows it, everybody can say it. And with our space, we define financial inclusion in a lot of different ways. We define it in some cases in some really antiquated ways. Do you have a bank account? That constitutes financial inclusion. Do you have access? That constitutes financial inclusion. We need some new definitions, but we also need that clarion call of of our net zero. And so that's why I'm here. Pleasure to be a part of it. Thanks for having me.
Well, Jesse, we appreciate you being a part of it, and for all of us sort of sharing that part of what is our personal call to action here. Dawson, what about you?
Good afternoon, everyone. My name is Dawson Hermany Horses. I'm an enrolled member of the Rosebud Sioux Tribe of South Dakota, and I lead Wells Fargo's Native American banking efforts. I'm a part of the commercial bank. I think for me, my background is in commercial investment banking. I spent most of my career focused on the casino industry. And 5 years ago, I joined Wells Fargo, and when I joined to lead our Native American efforts, I asked our leaders for more resources, and one of the things they said to me was, show us the business case, show us the opportunity in tribal communities. And I knew right away that I would have a lot of work to do because there isn't a lot of business or economic data about Indian country, right? There isn't a lot of information about the economic activity about tribal communities in the US. And, I spent a couple of months with a couple of analysts backing into publicly available federal data and creating a financial profile, right, and showing leaders at Wells the opportunity. And what that did was that whole experience made me realize is that, there isn't a lot of data about our communities. And if we don't have data about our communities, how can we make policy recommendations? How can we kind of treat and address some of these systemic issues, these wicked problems that impact tribal communities? I think Salah was talking about a Federal Reserve report. There's an FDIC report that talks about the, how Native American households are among the most unbanked in the U.S. Right? In 2017, it was the most unbanked. In 2019, it was like the second most unbanked. Right? But it's experiences like that have really made me realize that if we want to have equitable systems in the U.S. around financial inclusion, we need to remember Native American communities. And so I'm also a finance leader fellow with the Aspen Institute. So the opportunity with Salah to kind of strengthen the Aspen relationship is also important to me.
No, and we're grateful to have you as a part of that, and really grateful too. I think this dynamic of sort of saying, how do we make sure we focus on specific communities that are left out and understand how do we do that sustainably, right, for the long term is really important. Hillary, what about you?
Yeah. Hello, everyone. I'm Hillary Chidi. I am the head of the credit risk business at TransUnion, and I also wear another hat. I am the head of sustainability at TransUnion as well. Happy to be here, and I'm thankful to be invited to speak on this as well. What excited me initially about this was just a chance to tap into other discussions, other participants in this space, share a little bit about what's going on on this topic. This is a topic that we're very heavily focused on at TransUnion. I'm sure as well. This is probably the case at the other bureaus as well. And when you think about the ecosystem, it's hard to think about how you make advancements without the participation of an organization like mine. So we spend a lot of time thinking about it. I spend a lot of time trying to figure out, what are the most impactful ways in which we can actually, move things forward. And for me, I think I was particularly excited about the chance to basically be involved in the discussions around multifaceted solutions, whether it's policy changes or recommendations that we could make, and a chance to basically help to amplify the work that we've started in some circles. So I was super excited, and I remain so. Thank you.
Thank you. Well, and you get a taste here of the sort of leadership we've had around the many tables we've convened. I'm going to just give a few minutes of what we did, and then we've got I think a lot to walk through here. So over the course of the last few months, we engaged our working group members in a dialogue to say, this is exciting. We have a path towards a national strategy. What are the key priority issues that if we spent some time working on them, we could truly unlock the financial system and unlock greater outcomes for people in this country? Now, there are a million different things we could have come up with, a lot of different actions that we could have gone to. And we really pushed people to think about what are the issues that if we worked on them, they would They would impact this rubric of people's ability to access, use, and benefit from financial products and services. They would actually impact household stability, resilience, and wealth, and that would require cross-sector action to achieve movement in that space. And so I want to walk you through, we landed on 5 things. I would love to share with you like the full set of 15 or 20 that we talked through, but we were really good about getting to 5. And so I'm going to share with you a little bit more about these 5 different issues that we worked on, and invite, with each of these issue areas, we have sort of a call to action, sort of a question of how might we engage in leadership around these issues. We did publish a quick summary of those 5 issue areas in a blog post earlier this week. Those of you online can, I'm sure, click on the link and find that. And there is a longer form paper in the works right now that will be published in January. And so essentially we sort of landed on this space where we have on one end of the spectrum something that is a really critical kind of household focused set of issue areas around managing financial shocks. All the way through to sort of on the sort of more systems-oriented end of the spectrum, a focus on things like identity verification, fraud prevention, and open finance. So let's walk through these in short order. So the next slide, the first issue that I want to spend some time with today is this piece around managing financial shocks. And the way that our subcommittee talked about this, and I should be very clear, sorry for not saying this at the outset, but our working group on inclusive finance is an advisory group. They shared a lot of insights and recommendations with us. Ultimately, these are sort of Aspen's opinions and recommendations. Our working group members did not endorse these. So I want to be very clear. They have not gone through their own clearance process. And so as we think about this issue about how people deal with a financial shock, essentially a gap between income and expenses, we know, as we've heard already, nearly half of all US adults would have difficulty coming up with emergency funds within 30 days. It is not a challenge that is unique to low-income families, but certainly hits them very hard. To navigate those gaps, people turn to expensive solutions, including expensive debt. And that oftentimes the solutions they turn to may help that person in that moment of need, but they don't solve the long-term issue, right? And so it ends up putting somebody back into that sort of cycle of a short-term liquidity event. There are some promising solutions, whether that is emergency savings, insurance products, and some real, I think, forward innovation here in terms of small dollar credit products, and some business leaders who've been working on that here in this room. And the question really that was posed by our working group is how might we then improve households' ability to access, use, and benefit from short-term liquidity solutions to manage a mismatch between income and expenses. This is our call to action and a set of solution that we will ultimately come out with. So I've asked each of the panelists, we'll popcorn around here a little bit, to sort of think about their own reflection on what the call to action is here in this issue area, why it matters, and their own reflection. So Dawson, I'm gonna tee you up to talk to us a little bit about your take here on our work on managing financial shocks and short-term cash needs.
Sure. Thanks, Kate. And I'm not sure who said it at the beginning, but so much of the work we do is about people, right? And as I was kind of thinking about what I was going to say, I was also just kind of reflecting on my own experience with this issue. When I was, I went to community college in Wyoming and then transferred to a university in New York City. And I remember in that process of finding housing, becoming a student, getting books, there was a point where I didn't have a checking account, right? And I had to go to the check casher with, the scholarships checks that I was getting, and not knowing what to do, not knowing what my options were, going there, paying that $20 fee, whatever it was, and then being grateful, right, that I had this option, was a formative time in that early part of my academic career, right? And so I think for me, I have experience, doing this kind of work, or, having these kinds of mismatches as you described them. And I think, looking back on it as a banker, as somebody who's worked in finance for a while, part of what I understand now is that that fee is a part of the risk, right? That the check casher is taking on somebody like me who they don't have data about, right? Who they don't know anything about. Over the course of a day, they're getting a bunch of $20 fees, and that's how they're making their money. And as I think about like the future of finance and how organizations, like mine and others can kind of work in the space, part of it is just like, part of what we see is, better leveraging data, right? Leveraging sort of the information that we have access to. And I think, we have and kind of, have purview of a lot of customer data. And I think organizations like ours, and I think a lot of other banks, have started offering products using this customer data, right? Offering, short-term flex loans, right? I think 6 of 8 large financial institutions currently offer those types of loans. I know we offer a early direct deposit product, right, where you can get your direct deposit paycheck, 2 days early. Right? There are things like that that our financial institutions that are doing with current customers that I think are bridging that gap, or that are addressing that mismatch. But I think there's also like part of the challenge is also the people who are outside of the financial institution, right? Who are outside the system, who don't have access to it, who we don't have information about. And I think that's where we're going to need to kind of look at and work with all of you to kind of address these issues, because I think that's a huge gap. So
That's I think really a critical piece of this to sort of think about how are we serving the people already operating in the system today, and how are we sort of looking at what's happening and why people are operating outside of that. This theme of data and how we use it is something that's going to come up here multiple times. I want to move us to our next topic on verifying identity and reducing fraud. Now, David told me I wasn't allowed to pick a child. I will not announce who my favorite child is, but this is my favorite one. Only in that, just because it's super wonky and now you know about my brain. But it's really kind of interesting in terms of how this came to the forefront as a priority issue area among our working group. Sort of thinking about, in order for people to access, use, and benefit from this full range of financial services, that we sustainably provide them, we know that people must be able to verify who they are. And that servicing that as a financial services provider is increasingly a little bit difficult. And just there's a rapid pace of technological change that's holding promise for reducing the cost of doing this, for helping us to identify potential fraud. But there are also threats with the rapid pace of technological change that are with increasing fraud that is increasing the cost of service. And so, how do we kind of look at this and say, how do we reduce the burden for customers, make it easier to access these systems, while keeping bad actors out of the system? And the question that was really raised was, with so much progress and technological innovation unfolding, how do we ensure progress does not exacerbate inclusion and in fact drives benefit to people from those innovations? Joanne, I think you think about this every day.
I do indeed.
Yeah, tell us more.
So I just want to reinforce something that you said, because not everyone stops and thinks about the fact, by definition, you can't have financial inclusion. You can't be included in the formal financial system if you can't prove who you are. You can't have a bank account, you can't have a loan, you can't have any formal financial relationship anywhere in the world other than rogue regimes that aren't following the international rules. And this is aimed at anti-money laundering primarily and anti-terrorism. It's, for many of us, this is a non-issue, which is one reason I think in the United States we've been complacent about it to some extent until recently. But for years in emerging markets, people have been pointing at this problem. If you're a woman in many parts of the world, that your husband has the identity papers for the whole family, you don't have a personal identity. And therefore, you can't open your own bank account and you can't start your business and so on. So there's work underway all over the world in moving to creating digital identity. And in the US, there's a lot of concern about people who can't prove their identity, and there's also concern that our analog system of proving our identity, which has served us pretty well for a long time, isn't working anymore. All of our information is for sale on the dark web. You know, we are kidding ourselves if we think we have good identity systems here. And so financial companies are needing to verify in different ways. If we can create good, fair, accessible, accurate digital identity, we can unlock doors. And I've said this to you, I think of this as like a skeleton key because it solves for financial inclusion, it solves for fraud and money laundering because it makes it easier to identify these bad people. And it also solves, if you do it right, which is a big if, solves for privacy as well, better ability to control people's privacy. So we're looking forward to working with you. We're embarking on a project for a couple of years working on these issues, and I think it's really critical.
Way to foreshadow the future. I love that. Stay tuned. Some more work on digital identity to come. But Jesse, I'm curious, how are you all thinking about this at NCRC?
Yeah, and one thing I would say at NCRC, you know, we stand for some pretty significant and bold interventions to address historic inequality, but we also recognize, and you know, things like reparations, significant investments in home ownership and entrepreneurship, but we also recognize that on the one hand, without addressing those historic inequities, we think you can't really create an inclusive society. And then on the other hand, you could wipe out historic inequities and continue to recreate an economic system that was not inclusive. And the reason for that is the kinds of things that were just talked about in terms of liquidity, a wealth inequality driving much of this. And then the fact that people are, you know, being targeted, their money's being stolen. They're engaging in market transactions on equal terms. And so when it comes to verifying identity, reducing fraud, I mean, step one is being able to control your identity, verify your identity, not have others use it against you or use it in a fraudulent way. And then we think of fraud, really, I would say, a whole spectrum of behaviors ranging from fraud, people targeting you to take your money, steal your money in a variety of ways, all the way up to and including things that are not fraud, but get towards sort of progressively sort of no utility to you as a consumer to marginally more utility. And so that's when you get into the space of unnecessary fees and other things that you may be getting charged, and being able to take control of all of that. One, to protect yourself against someone stealing your money, but two, then to also know when you're paying too much for something, or when you know, you might be getting a hidden fee or something that is not fraud per se, but might not be welcomed, might be just a result of the market power that the person you're transacting with has over you. And how do we use technological change, which will make many of these problems worse? The ability to target you on the basis of your identity, to scam you, to even mimic you in ways to prove that they have your identity, are only going to progress and get worse. How, on the flip side, can we put technology in people's pockets so that not only can they protect themselves, but as they engage in the market, in market transactions, how do we make it easier for them to monitor what is going on with their financial identity? Can we put AI in their pocket to say, hey, AI, please monitor all of my financial transactions and alert me? And I worry that if we don't maintain sort of a net neutrality type framework around some of these technological innovations, that what will end up happening is technology will be captured by companies with an interest in controlling it, and that what won't happen is we put it in people's pockets, that they're able to effectively use technological innovation to protect themselves, to verify their identity, and to make sure that they're getting a good deal when they engage in basic market transactions.
I saw you. Did you want to jump in there?
I was just going to say, I think we almost might have gotten through the event up till now without talking about AI. But
Sorry.
no, we need to. But yeah, just think about generative AI and the scams that are coming. How are people going to protect themselves? And the old-fashioned methods are not going to be enough.
It's interesting when you say skeleton key here, because I think one of the pieces that animated a number of us around this issue was one about how such a, really important, critical piece of this financial system's infrastructure has the power to really address issues of trust and control that we know are really a powerful element of this conversation around inclusion, right? And so I think it's really important to elevate that. I want to move us forward here because this is, I think, a corollary topic and has some interesting parallels here in our next issue area, which is on pricing credit and risk more accurately. So you've been wondering, when are we going to talk about credit scores? And what's really interesting in terms of the conversations that we've been having is that, this is a little bit about credit scoring, but it is much more fundamentally about what a credit score is and does, and really examining that root sort of use, if you will. It's something like almost half of adults in America are below a prime credit score. So if you have a prime credit score, probably the credit system's working pretty well for you. You can have access to most products. They are, fairly well priced for you. And other than that, it's the current credit scoring system, particularly for people who are below that prime credit score, it doesn't fully capture your financial life necessarily. You can disagree with me, Hillary. Let me know what you think. And we already know that there is a lot of other kinds of data that could be used for underwriting, is starting to be used for underwriting in some places that help us to really unlock a bigger piece of the puzzle. And ultimately, this conversation came down to, if we think about it both for households and for credit providers, are we actually getting accurate and good signals about somebody's ability to repay? And does that help a provider to accurately price the product for the risk that's there? And so the conversation kind of landed on this question of, for consumers who currently face challenges accessing sustainable and responsible credit, how might we remove barriers that prevent the collection and use of information that would more accurately price risk and assess the ability to repay? I think we would like to hear from you, Hillary, how you think about that.
Thanks. Yeah. So this is my favorite child, and as perhaps the only parent that actually does have a favorite child. I think it's actually important to start by maybe just taking a step back and thinking about the scale of this, right? You asked a question about do credit scores accurately represent the right information? The answer to that is it depends, right? For those for whom you have data, it does reasonably, right? But the credit score is indeed a signal about your ability to meet future credit obligations. Now, the challenge that you were just describing is for the tens of millions of Americans, the 45 million Americans, for whom, who are basically credit invisible. So for whom there is either not enough data to present a conventional credit score, or there is no data at all. And so they basically are not represented in the conventional credit scoring system. That's where the challenge really exacerbates. And when we talk about inclusion, it's really that's where the problem really manifests. And John was also right that it's almost, you can almost look at it as an identity issue almost, right? If you can't see someone, they can't be part of your credit ecosystem. And I think your comments also at the beginning was also spot on, right? It essentially is the pricing aspect is a measurement of uncertainty. If a lender or an underwriter is able to basically have some reasonable assurance of who you are and your ability to meet future credit obligations, they will price you accordingly. The more that uncertainty rises, certainly the pricing of that risk, rises as well. But the key issue is, why do we have 45 million Americans who are out of that ecosystem, right? In Ida's opening statements, one of the things that she talked about was just the sheer level of sophistication of our economy. By far the most sophisticated capital markets anywhere in the world. Incredible banking infrastructure, incredible set of processes, governance, and frameworks that basically enable the flow of capital through the country. But yet we still end up with 45 million people who, for the most part, just like your mother, when you went to try to get that loan, you hit a roadblock and you get to this point where the bank can serve you, or essentially why? Because you don't have credit. And how do you get credit? By having credit, with this weird paradox where you need credit to get credit, and you get into this loop that many millions of Americans cannot get out of. Now, the great thing about this for us right now is that we have pathways to solutions, right? We have data sets, we have information for consumers that can really be used to basically bring them into the light, right? So rental data, utility data, telco data, and of course even banking data are all data sets, categories of data that, with the availability of this data being out there, being able to bring these data sets into consideration is really kind of like the first step to really bring in the 45 million Americans back into the credit ecosystem. But there are many steps to that, though. Just having the data is not enough. We need to have the data. We need to have, of course, the models, the underwriting models, the credit ecosystem needs to be able to support the use of that data to basically score the individuals. Those models need to be adopted by the lenders and by the underwriters, by people who basically use them to basically make decisions on Jane Doe and say, hey, this individual, we can see that she has paid, she has 28 months of steady rental payments and utility payments, and we have a reasonable assurance of our ability to basically take on a mortgage of similar size to the rental payments that she's already making. That's just a clear use of that. And then, of course, the consumers, of course, also need to be adequately informed, educated, and brought into the light as well, to ensure that they also treat these other data types with the level of, I'll say, significance that they deserve, right? It is helpful to pay your rental payments on time. It's helpful to pay your utility and other types of bills on time in order to gain these advantages. So, but I am encouraged, though. I mean, like, from a policy perspective, we've seen advancements, right? California had Senate Bill 1157 that advanced the reporting of rental data. Now it was limited to only public housing only housing that received public subsidies, but that was a step in the right direction. And here in DC, Congressman French Hill introduced the Credit Access and Inclusion Bill this year, which has also been introduced in the Senate by Senator Tim Scott and Joe Manchin. So, and all of these will the legislation will greatly shift. When it comes to fruition, hopefully it comes to fruition soon, will greatly shift that momentum and get more of this data, being used, being reported, being used, and basically being used to bring more consumers into the ecosystem.
Yeah, thank you. I mean, I think it's upon reflection, both sort of your comment, Joanne, about the pace of technology and here kind of the technology coupled with the pace of how we can use data, there is incredible promise. There are complex systems at play that's going to require policy and regulatory change, requires ways of thinking about how we use technology. But to me, it's also critically important, and why this idea of a national strategy is really powerful, to say, in the pace of all of this excitement, how do we stay focused on whether we're changing people's lives for the better, right? And that's, in terms of the call to leadership that we have in this moment, it's exciting to hear that focus of why we do this in this work. I'm going to keep us moving through our issue areas, if that's all right, because this next topic that we have is, I think, also a nice, important pillar to stand up alongside these conversations, which is where are we going when it comes to a conversation around open finance. This notion that consumers actually could or should or can have rights over their own financial data and permission access to that data. And it is, in the conversation that we had with our working group, fundamentally about unlocking a more competitive financial system is the sort of the crux of why this matters. Of why giving consumers more control over their data would be part of a conversation around financial inclusion. We are at the start of that journey here in the United States, with the CFPB just issuing proposed rulemaking around open banking for certain types of financial products and services. And we talked about the promise of open finance doing three things for consumers: lowering costs, driving better services, and improving the user experience if it's all implemented effectively. And so the group sort of says, how might we drive those benefits of competition to more consumers by making it easier for both people and providers to safely and efficiently share data through open finance? So I want to, I know, Jesse, you were one of the brave souls in one of our early working group meetings who said, I want to stand up for this being really critically important. Tell us more about your thinking on that.
And I'm going to surmise that since this one was last, it might have been someone's least favorite child.
No, there's one more.
I'm joking. I only have one child, and I constantly confront the challenge, like, does he know he's the only child? Is that good? Maybe got to keep him on his toes a little bit, like, maybe you're not my favorite child. But this really important topic, and I want to get conceptual for a second, and then I'll come back to open banking and the CFPB's rules. So, Adam Smith's theory of competition, market competition, theory of capitalism was fundamentally, the idea was, in a market-based transaction, you have mutually beneficial outcomes for both parties. But it was predicated on a really important condition: perfect information on both sides of the transaction. That's what he said. He said it produces a mutually beneficial outcome when you have perfect information on both sides of the transaction. And so within our economy, what we see is that wealth inequality, and it leads to a power imbalance. It leads to information asymmetries that mean that most market transactions do not occur with perfect information on both sides of the transaction. And so fundamentally, most market transactions accrue to the benefit of one party over the other. And over time, over hundreds and hundreds of years, that's how you have a reinforcing negative feedback loop of asset poverty, of wealth inequality, that people who have the least wealth and the least access to information engage in market transactions on an unequal playing field, and they end up being taken advantage of by those market transactions. This, by the way, is not a radical theory. This is Adam Smith who said this. And so if we think about making markets work effectively and efficiently and in ways that are fair and that produce mutually beneficial outcomes, we have to think about those information asymmetries on both sides of the transaction. Now, open banking and open finance is one of those things. I think there are other things that we need to think about in the context of competition, namely as companies merge and we see consolidation in industries, or we see certain industries dominated by one or two or three players, that we need to make sure that as they grow, and if they're allowed to have that kind of market power, that they are producing outcomes that are beneficial to consumers when they transact with them. One of the ways to do that is to think about giving consumers more power over their own information. So not only do consumers engaging in market transactions, often are they at a disadvantage with respect to what the other side of the transaction knows. So a person getting a mortgage might do that 2, 3, 4 times in their life, where the mortgage company or bank will do it millions of times. That's an asymmetry. But also, they may be at a disadvantage with respect to their own information, banking information. And so making that data portable, enhancing their ability to go out into the market and get people to compete over them, enhancing that level of competition among financial services companies to drive down pricing. And I think a really important part of that is transparency around pricing in a variety of data regimes, thinking about that in the context of 1033 and the CFPB's rules, but also in other ways as well. If we can promote more competition for those consumers by empowering them with more control over their own data, which is an asset of types, perhaps we can enhance the level of competition and drive down prices, resulting in a more mutually beneficial transaction when they engage in the marketplace.
Yeah, thank you. And I think that's a great example, too, of how we've really kind of looked at, here is sort of an emerging space where our financial system is making rapid change. At its core, what is it that we need that change to do to make it better for consumers? And that's really kind of that focus on competition, and how do we make sure that we can kind of continue to use that to drive a better experience, better pricing, better outcomes for households is really critical. I appreciate that you raised that. Did you want to chime in on the open finance?
I'll just say, and maybe it's obvious, that another piece of this, another dimension, is that you can minimize the switching costs. So you not only can have more competition, but it can make it easy for you to just switch to a better provider.
Yeah, definitely. All right, we're going to do 2 lightning rounds to finish this out here. Okay, our last issue area that I want to raise here, and it's one I'm going to ask each of you to really talk to. It's really kind of gets at sort of fundamentally kind of how our financial system currently works, particularly when we think about the business models for financial services providers. So we talked about how there is kind of a fundamental tension between wanting to serve more people, particularly communities that have been traditionally excluded, whether that's race, gender, geography, and being able to offer those products and services sustainably and affordable over the long term. And there were sort of a few issues at play here. One is that sort of traditional, or not, maybe I shouldn't say traditional, but there are some business models for which the ways that you drive revenue are putting you at odds with a person's financial health and well-being. So as an example, you can think about frequent overdrafters. That's a service that obviously people are using because they have a liquidity need, but is that in service of their financial health and well-being? It is certainly in service of revenue, right? As an example of this conversation. And the other challenge we talked about is how financial institutions have historically been organized, siloed by product line, right? Rather than thinking holistically about the customer and their full range of financial products. And so, as we wrap up our conversation, I want to invite each of you to respond to the question, how might we rebalance the financial system to account for this mismatch between long-term consumer health and incentives for financial service providers? Go quick, because we have one last question, too. Dawson, I'm going to start with you, and then I'll end with you on the last question. Sound fair?
That works. I think, as I think about this issue and this challenge, really, right? How do we create an inclusive system? I think, we need to think about everybody who's a part of that system, right? And we need to think about the incentives that every kind of participant in that system has. I think when we design solutions, we need to think about and try to reflect, if we can, and I don't mean to be really abstract, but I think about, in the Native American finance space, there have been solutions where, the federal government has tried to encourage homeownership by designing federal loan programs. But, these programs were designed, it feels like, without input from banks. Right, and they're also not flexible, right, and they don't reflect kind of the evolution of the mortgage industry, right, and so they become very cumbersome without kind of serving the intended borrowers. And so I think as we're thinking about these systems and ways to include and improve access, we just need to think about the incentives of everybody involved.
Yep. Jesse, over to you.
Yeah, is this on? Well, maybe it'll come up. Can you hear me? No. All right. No. Well, I'll talk loud. Sure, I'll use yours. So, when I think about this, two things I would point out. The COVID was a really instructive lesson in what happens. I mean, it was a moment of terrific, instability potentially for a lot of people. And then it actually became a moment where suddenly we had, in a lot of ways, more financial inclusion than we had had, at least in recent history. And what happened? Massive, widespread inflation. And why did that happen? Because the economy is not built for financial inclusion. What that tells you, when people get included in the financial system, what actually happens is prices go up so rapidly. Why? Because the economy is not built for that many people to be included in it. Think on that for a minute. And so we do need to think about, and the reason for that is people in low and moderate income communities of colors, are constantly in a state of recession. They didn't enter into recession. They have been in cycles of recession all of the time. Their personal balance sheet is getting crushed over and over and over again. And when we take them out of that, it actually, there's a negative side to that. It's positive when we think about the financial opportunity, the economic opportunity that Salah mentioned. We estimate $500 billion a year of lending activity if you just leveled the lending disparities between white people and people of color in small business lending and home mortgage lending. $500 billion a year in lending activity that's not happening. But we have to control for the other side of it. I think to more directly answer your question, people will throw stuff at me when I say this. I think every financial services company on some level ought to have a fiduciary duty to their customers. I realize that legally defined, people, that's where people will throw stuff at me. But conceptually, you should have a stake in the outcome of the people that you're serving. Whether that's a formal fiduciary duty or not, you should have a stake. There's different ways to do that. In Dodd-Frank, on the mortgage lending rules, we said you're going to retain 5% of the risk. So that's a way of getting some skin in the game of the outcomes of those mortgages. If they go bad, you have 5% of the risk. How can we think about that conceptually to make sure there's alignment between good outcomes of the provider and of the consumer?
All right, I'm going to throw our last question in here so you can respond to both at the same time. So how do we create a win-win? And I think we've seen today what an incredible amount of leadership, and you've just gotten a taste of it, there is, and exciting momentum. What is your call to action of your colleagues, your peers in this room and online? Both of your questions. Over to you, Joanne.
I'm going to go back to where I started about the technology. I have spent my whole career working toward consumer financial inclusion and protection through regulation. I was present at birth for the Community Reinvestment Act. I was on the Senate floor, so that really dates me. And I worked for the main sponsor of it. And we need regulation. God knows, again, I've devoted my career to it. But you can't regulate these systems into getting you where you need to get. It's not enough. And with the technology changes that we have today, you can change the economics of serving bigger and more varied markets. You can change the incentives. If we had the time to do it, we could ask the question, what causes people problems in their financial lives? And we could go around the room and talk about not enough money, not understanding the product, not being able to save, on and on and on, not being able to qualify for a loan. Technology can massively help with every single one of these problems if we do it right and educate right. So my call to action is to be careful that we don't accidentally choke off promising change without thinking through what the upside opportunities are with it. And my other quick call to action is, and we've touched it throughout the conversation today, if we can move to an outcomes-based way of thinking about these, if we can define consumer health. I'm very proud of when I listened to the acting controller talk about the OCC's project on measuring health. That came out of an initiative at my little conference a few years ago, where some people got the idea and turned it into a Harvard Business School paper and so on. And we could do that now with the data that we have. If we decided what good looks like and we rewarded the market from a regulatory standpoint and a market standpoint for producing that and for doing, as you say, there's an analogy to healthcare. The question is that these financial services should be both safe and effective. They shouldn't hurt you if you use them the way you're supposed to. And so there's just a huge opportunity there.
Oh, thank you. Appreciate that. Hillary, go quick, though. They're yelling at me.
All right. So, very quickly, I'll say the call to action for me is really about focusing on, to the point about policy, right? Focusing on policy that basically does drive a meaningful, innovative change, right? We have lots of startups, fintechs, others that can basically come in and bring in different types of solutions out there. Why aren't we seeing more impact and more change there? Typically because the barriers to entry, barriers to growth, barriers to scaling. The more we can introduce policies, frameworks, and other things that help to reduce those barriers, the more we will see impact basically happen in that space, right? Open banking is one of them, and other things like that. So that's really where I will focus, at least one call to action that I'll have.
All right, you're in the right town for that. Jesse.
Yeah,
Go quick.
I think in the long term, all of our interests are aligned, right? The human race depends on the Earth still existing. So that's an example. In the really long term, people's self-interests are aligned. The problem is often in the short term, our self-interests are not aligned, or we don't think they are. How do we better align people's long-term self-interests? And I think you actually have to think about some core market fundamentals with that respect. You have to think about short-termism and the fact that companies are motivated to report their profits quarterly, and you have to flip that on its head. And I think you see that within the ESG field and CRA and social impact investing. We have to push really hard on that because I think it would enable and allow innovation to occur in the context of people being able to invest in innovation in the short term, stop thinking about self-interest in the short term, think about it in the long term. If we don't include communities of color in our economy in the long term, we won't have an economy that sustains the level of corporate profits that we have today.
Thank you. All right, Dawson.
All right, I can keep it quick. Whenever I have an opportunity to kind of share a call to action, I always say, don't forget tribal communities. But I think even an offshoot of that would be like, who isn't here, right? Who isn't here? Who else needs to be at sort of this table that we're all sitting at, and in this conversation? So I think, let's think about that. Who should we invite to kind of join us?
I love that. Thank you so much. So just to wrap us up here and today's conversation, I hope that all of you are as inspired as I am. It is a truly, I think, exciting moment for us to think about the future of our financial system. As we look at the kinds of leaders who are standing up to take action, who are asking for others to come alongside with them. It is a moment for us to collaborate and join together. It is a moment for us to be crystal clear about why we're doing this and the outcomes, the impact that we want to be having. So here at the Aspen Institute, we certainly are part of that call to say, please come join us, talk to any of us, drop us a line in the chat. We are really excited to continue to partner in this conversation. And I want to just say a quick thank you to everybody who made today possible, to all of the speakers and their staff who I know work hard when their bosses have to stand on a stage. I appreciate that very much. And particular also here at the Aspen Institute to thank Emmy Urban and Aaron Borge for their time in helping to prepare us all today. Thank you for being with us, and we look forward to continuing the conversation. Thank you.